We'll see overall question with the solution. This set is January 18. So if we see the question, what is this? Working capital management deals with decision regarding the approximate mixed and level of current asset and current liability. Answer with example. So if we see here is the 6 marks, and we know in our Chartered Secretary, question number 1 is the mandatory. We have to answer question number 1 and all paper, within all paper. So and number 2, distinguish between a permanent working capital and temporary working capital. And this question can be very, for example, if we see the permanent capital, you can say it is the fixed capital. And if we see the temporary capital, we can say it variable capital. So that question can become this way: distinguish between fixed working capital and variable working capital. And that is also the permanent and temporary working capital. How do market force, both shareholders, activism and threat of overtaken, act as a prevent or minimize the agency problem? What role do the institutional investor play in shareholder activities? So here its marks is 8, total 20 marks. So if we go to the answer, this is the model answer. Working capital management deal with decision regarding the appropriate mixed of the level of current asset and current liability. So we know the working capital management refers to a company's managerial accounting strategy designed to monitor and utilize two component working capital, current asset and current liability, to ensure the most financial efficiency operation of the company. So this is the fundamental and basic logic thing. And the primary purpose of working capital management is to make sure the company always maintains sufficient cash flow to meet the short-term obligation, cost and short-term debt obligation. So this is the few thing. And we know the working capital, the main component is inventory, receivable, current asset, payable, others liability, etc. And we can calculate this working capital equal to inventory plus accounts receivable plus other current asset minus current accounts payable minus other current liability. If we can calculate working capital, and also we can calculate another way. First we have to calculate the current asset, and then we have to calculate the current liability, and if we adjust it, then we'll get the working capital. And sometimes working capital can be negative. So another thing, determine the working capital. How determine? There are some internal factors, some are external factors. Here internal factors: nature and size of the business, operation efficiency, company's production policy, production and also company's credit policy, available credit, growth of business, profit margin, dividend policy, etc. And external factors are business cycle, change in technology, seasonal variation, tax policy of the component of the country or land, law of land, and price level change, inflation, etc. The external factor. So this way can be summarized. That question is here. The current asset formulate equal to the addition to the all balance sheet asset that can be converted to the cash within 1 year or less. Current asset include cash, equivalent, inventory, etc. This is the example of current asset, and also same way current liability. So this we can be just model answer. This we can be answered. And when we start for the writing, we cannot write this huge right, but we write the fundamental thing, and we have to make a picture, that type of box, how working capital comes, code, etc. So if we see another one, distinguish between the permanent working capital and temporary working capital. This can be, as I say, this permanent can be fixed, temporary can be variable. So answer would be the same. just word replace. So permanent working capital refers to a level of current asset which is maintained and vital for the company to carry its business regardless to operation level. Uh, while temporary working capital refers to the working capital which is over and above the permanent capital or fixed capital. So permanent capital, we can say the amount that firms or company must keep invested in short-term asset to support continuing operation. And temporary working capital means the difference between the actual level of investment in short-term asset and the permanent working capital investment difference. So if we see the picture, this one, we'll be able to understand clearly here. This straight line is the permanent working capital, and above the straight line, it can be varied, it can be variable, it can be temporary. So it is the temporary working capital, or if the question will come the fixed working capital and variable working capital, so this permanent would be the fixed and temporary would be the variable. And in the left side, working capital in taka or dollar, you can say it, and the below side, that means x-axis, it would be time. So this is the distinguish between the working capital permanent and temporary. So it is enough for answer for 6 months. And if we see our number C, is marks as age. How do market force both shareholder and their first we have to know the shareholder activism and trade of overtaking minimize the agency problem. So have to understand what is the agency. Agency means we can say that that means manager and owner of the company, they are a true agency, because owner of the company, they wants more dividend, more increase the share value, and manager wants more salary, more benefit. And also here if our creditors or also creditors, they want timely money, timely payment. So there is some conflict. If profit higher, then salary and other expense would be lower. If expense lower, then salary higher. And owners always want to reduce the operating expense or administrative expense of the organization for that means getting more benefit through the dividend. So that's one type of agency, and that type of agency some conflict, some problem. As problem is that if wants dividend more, then have to reduce the expense, and if reduce expense, the manager will get or employees will get less salary or less benefit. So that type of problem, that type of agency problem, if thing with the institutional record at the agency, that type of problem can be happen. So here question is that activism the threat taken over agency problem, what role the institution investor play a shareholders activism. So here the constant threat of taken over trained to motivate management to act at the best interest of the company's owners. If company stock is depressed, it make the attractive taken over target. So this is the taking also the for the here the taken as the taken over or merger, and as a result this trend of motivation management to act the best interest for the company's owners. Institutional investors include owners and activity investor. Here most institutional investors do not set out to become activity shareholders, nor do they want to gain event with company's operational issue. For most institution, an approved shareholder active, that's so. This can be say we will say here how do market force, both shareholder and the threat overtaken, act as a prevent or minimizing the agency problem. So sometimes there are some employee agency also. We know in the government organization we have the CBA, collective bargaining agent. So they are the authorized representative of the employee. They got the registration from the Ministry of Labor, and they have the right for the politics or gathering for taking the good thing for the employees. So that's also sometimes can be problem. That type of problem can be solved through merge one company to another. So that type, for example, if a good company merges a smaller bad company where his agency problem is huge, so that agency can be removed from that company after merging. So that type of answer you can just write this way. And if we see number 2, the answer first to 1 of that question was March 5. What is capitalization in finance? Answer would be that. In finance, capitalization in finance is the sum of company's debt and equity. It represents the capital investment in the company, including bonds, share, and also the market capitalization is the value of the company's outstanding share of stock. It also represents the value of the companies according to investors' perception. So, market capitalization, we can solve capital market cap means the market value of the company. So, that type of answer we can be solved this way. There are capitalization means market. That means we know the equity capital as well as loan capital or debt capital, all are the capital. So that capital with the name in the finance. So if we see 5 marks, question 2b, discuss the factors to be considered in determining the capital structure. So it's that type of question can be happen with the rectify again. So discuss the factor that consider the determination of capital structure. We can say that the following factors can be that is influence. What is? Two types: internal factor, external factor. So internal factor, financial leverage within the organization, and that means debt equity balance, and within the risks, growth and stability, retaining control, how much money they can retain, how much money or profit they can retain within the organization, not giving the dividend. So it's also internal factor. And cost of capital also affected, and cash flow, flexibility, purpose of finance, asset structure, etc. is the factor affect capital structure is the internal factors. And if we see the external factor, that size the company, nature of the industry, nature of the investors, cost of the inflation, a legal requirement, period of finance, level of interest rate, level of business activity, available of fund, taxation policy, level of stock price, condition of the capital market. That would if efficient capital market, that type structure also influence. So we can say this way the capital and number 2 here 10 marks. This math comes from designing capital or chapter of capital structure. So if we see the math here, one company has to make a choice between debt issue and the equity issue. So here between debt and equity issue have to make choice for the expansion program, and its current position is that 5% debt, equity capital taka 10 per share, surplus 30,000, total capitalization. So look here, this is the total capitalization, include debt, equity, surplus of fund, result of general reserve, because all item owner of the equity holder. This is the figure. And if you see the sale, 3 lakh, total cost 2,96,000, earning before interest tax is 31,000, and interest 1,000, earning before tax 30,000, and paid the income tax, that was 10,500. Then income, earning before tax, income, that would be the after tax. Income after tax 19,500. This is the scenario, and few additional scenario here. The expansion program is estimated to cost 50,000. So new expansion, if the financed through debt, the rate of interest is new debt is 7%. Look here, old debt as within the balance sheet 5%, but new debt we have to take 50,000 or 50,000 million. It can be is 7%, and the price earning ratio will be 6. So this figure we have to consider for choose the which item we have to take, debt or equity. And if the expansion program is financed through the equity, new share can be sold netting 25 taka per share, and the price earning ratio will be 7. But the debt price earning ratio is 6. The expansion will generate additional sale 1,50,000 with the return 10% on the sale before interest and tax. If the company is to follow a policy maximizing the market value of its share, which of the following should be choose? That means which item, how they invest it. One is equity or debt. So if we go look here, the answer, this is a chapter of designing capital structure, 10 marks. Here answer is that. Financing plan, they have the two plans, 7% debt and equity issue. Earning before tax as given in the question, 46,000. This is that, this one. Okay, look here. So we have to calculate this one first. That's why we are working note. Present earning before tax 31,000. This one. Earning before tax 31,000 plus expected earning before tax 10% of 1,50,000. This one, new one. 10% of 1,50,000. So total 46,000 earning before interest tax. So this is 46,000. From 31 now 46, so 46,000 earning before interest tax in the both case. Less interest 4,500 because rate of the interest, how come? Presently interest is 1,000, and if we go for earning, that means debt 50,000 at the rate of 7%, that would be 3,500 plus 1,000 previous, so 4,500. And in the case of equity, only previous interest have to calculate, only 1,000, because the 50,000 financing through the equity, but here through the 7% debt. That's why here interest is more than equity. So here earning after interest 41,500, and the case of equity 45,000. And tax, here we have to calculate there is no tax rate here, but we have to calculate tax this way. Look, income tax here saying 10,500. So 10,500 is the tax on 30,000. So if we calculate this, the rate will come, and applying that rate, we will get here tax 14,525, and here 15,750. And if we minus from that figure, we will get earning after tax 26,935 and 29,250. And now the EPS, earning per share. So how come earning per share? We have to say the number of share. What it come? Number of equity share with the debt financing. The number of ordinary share Here, look here, number of ordinary share with debt financing, and if taka 10, so here 5,000 share. Same way, number of ordinary share 5,000, 50,000 divided by 10. In case of equity financing, additional 2,000 have to issue. How? Look here, as per the question, they're saying that can sold netting 25 taka per share. So 50,000 divided by 25, then we'll get 2,000. So total number of share would be, that means here, look here, here 5,000 and here 7,000. So 26,975, if we divide with the 5,000 number of share, then we'll get. So another thing here, this 5,000 share come from here, equity capital, taka 10. So number of shares here. So if we invest in this with the dev, no need for issue, increase the share. So here 5,000. It's come, earning an EPS come 5 taka 39 paisa. And here we have to divide it with the 7,000 share, because 5,000 existing and another 2,000 for investing 50,000 taka. So here, if we divide 29,250 by the number of shares 7,000, then we will get EPS 4 taka 18. And price earning ratio, as said in the question, as mentioned in the question, price earning ratio is the here 6 with the debt financing, here 6 with the debt financing, and here 7 with the equity financing. So these 6 and 7, if we multiply earning per share with the price earning ratio, if we multiply, then we will get market value per share for the debt financing 32.37 and here 29.25. So what is the value of the huge higher value of the share? Here basically we say that here the company should choose debt from a financing to maximize the market value of a share. So look here, market value of share increase if debt finance arranges. So the answer is here. So we complete 2. Now 3. 8 marks. Question number 3. Maximization of a stock price does not make sense because investor focus on short-term result. How will it satisfy shareholder? So this is the question. So answer will be that the objective of decision making in corporate finance to maximize a company's value or stock price. The purpose of the business is to make money. A conversion with the almost the business man or economics show is to show why should, that means here if we say that wealth maximization is come from maximization of shareholder wealth, and wealth means net present value of financial decision that will be equal to present value of future cash flow minus initial stage cost. So this is the wealth maximization model versus profit maximization model based on the cash flow and profit. And here industry alternative comes source of wealth creation. How come? That means substitute industry creation. That means we know the Porter 5 first model is also the help for wealth creation. Here this is the Porter 5 first model, and competitive advantage, cost advantage, differential advantage. Lot of things is here, but we will not be able to memorize all things. But if we see that type of huge thing, then will be memorized just something or just basic to the point item. So that way you can be answered that one. Lastly, we can say that the first of the investor short term in the focus, while there is evidence of the some investor focus on the short term, market seems to the face favorably in investor and research announcement, and long term consequence it not be positive, long term it will be possible. That type of answer that we can be favor. And how the shareholder value create is another graph, but where revenue growth, if revenue growth, then shareholder value it create. How revenue growth increase the volume and also increase the price of the item, and also operating margin, that means if expense go less and sale go high, then the shareholder value would be high. And capital efficiency, if property, plant and equipment can be used properly, if inventory managed properly, and also that means working capital managed properly, that can be capital efficiency can be happen. And by this way, if we together all thing, revenue growth, operating margin, positive impact, huge capital efficiency, utilization of capital rightly, effectively, efficiently, that can be happen shareholder value creation. So this we can be solved or answer this one. And if we see another one, 7 marks or your number 3, what is a dividend policy? So we know the dividend, and we know the dividend policy, the policy a company used to structure its dividend payout to shareholder. So this is the, and discuss how dividend policy determined by a board. So within the dividend policy, we know dividend policy depend on company's growth. This is the, if we see this box, just look here. If the company's profitability growth, also the if the profitability increase, ownership structure would be, that means if we see the debt and equity ratio, age of the company, extension share distribution, that means shareholders expectation, taxation policy of the country, and business cycle, leverage ratio of the company, and where the company existing, that means type of the industry, etc. And also the management purpose, what management want, what the board want. So that type of item all depend on the dividend policy. So that's why we can be solved or answer this one. And another one, question number 3, 5 marks. Distinguish between spot exchange rate and forward exchange rate. That question comes from your last chapter, chapter 8. So here these are the spot rate is a contract price for a transaction that is taking place immediately, and a forward rate, on the other hand, is the settlement price of a transaction that will not take place until the predetermined rate in the future. That is forward looking price. So a spot rate means that then and then, within that time, a spot. And forward rate, that means future, the specific time and the agreed time. So this is the picture of forward and spot. So this you can be solved. So look here, question number 3, totally theory, 20 marks. And question number 1, it also just 10 marks. Question 2, 10 marks theory, 10 marks math. And question 2, here 100%, question 1, 20 marks is theory. Now comes question 4. It is a math, 8444, 20 marks. This question comes from debt and financing risks, financial risks, total 20 marks. Here one company, that means here look here, is giving sale, and is the probability 2, 0.2, 0.6, 0.8. And so also we know the Actual, when we go for the probability math, that the probability would be 1 is 100%. So here 0.2, 0.6, 0.2, it's mean that here 100, that means 1. So sale can be happen 2 lakh is probability 0.2%, and also sale taka 3 lakh is can be happen is probably 0.6, and 4 lakh it can be 0.2. The firm has fixed operating cost 75,000 and variable operating cost 70% of the sale level, and the company pays 12,000 as interest and pay dividend 10,000 ordinary share as per the dividend policy of the company in each level. The tax rate 40%. Here we have to compute the interest before interest and tax for each level of sale. So here 3 level. If we go for calculating number 1, and also we have to calculate 2 also, compute the earning per share EPS for each level of sale. So these 2 items we can solve in within one side. Here, look here, this is the answer of AB. So probability 0.2, 0.6 and 0.2. Sale 2 lakh, 3 lakh and 4 lakh. So variable cost 70% of sale, that means sale 2 lakh is variable, this one. Fixed cost 75,000 in all level is the fixed. So earning before interest tax, it would be here minus, here plus, here plus. Less interest 12,000, 12,000 all in level same. So earning before tax is this one. So less tax 40%. So here if we see in the level of 0.2%, what would be happen here? That means tax is positive is come here. Sometimes company is giving, that means we know in the tax law there is some adjustment also. If loss, this loss can be carried for 6 years. So considering this one here, earning after tax here 16 2, here only two item is positive is the minus, and number of share 10,000. So EPS comes here minus, here plus, here plus. This is number 1 complete, number AB. Now 2, that opportunity to reduce the leverage to 0 and to pay no interest, but that means that they have no debt. This will require the number of share outstanding to be increased 15,000. Repeat B under this assumption. If we think that leverage ratio is 0, that is no debt, and increase the outstanding share up to 15,000, presently number of share 10,000, it would be the 15,000. So what would happen in the case of EPS? This is the question. So answer would be that this one. Here, as we calculate earning before interest tax, this one. So taking this earning before interest tax less interest, because here no interest, because here we minus the interest 12,000, and now condition is that no interest with the organization, that means 0 interest, that means is the nil. So that's why earning before tax and earning before interest tax is the same. Now we have to pay the tax 40% and earning after tax, and if we divide number of share 15,000, so in 3 level is come EPS 0.6, 0.6 and 0.6 minus, 0.6 plus and 1080. So this is the difference between 2 items. And again said that compare B with C and comment on the company's financial risks. So this is the theory. So here when we compare EPS with and without debt, one is with, another without debt, it is clear to see that estimation depth from the firm's capital reduce the overall financial risk. So this answer is okay. Now number 5, EPS and P ratio calculation. Here marks is 4, 8, 8. That's the total 20. So look here, 4 for A, 4 for B, and 8 for C. Very small math. One bank recently reported profit and loss. Net profit after tax 100 million. It has 2.5 million share outstanding and pay dividend on preference share equal to 1 million per year. Calculate the bank earning per share. That means calculate the EPS. Then assuming that share currently trade 75.8 per share, determine the bank's dividend yield would be if paid 10 per share to ordinary shareholder. And see, what would be bank's dividend payout ratio if it paid taka 10 a share as dividend. So look, this is the answer. Very small math, but marks is used. 488. So if we go for number 1, calculate the EPS. It is very much easy. Calculation of EPS. Here 4 marks, just only one line. EPS here 1,000 million earnings minus 1 million. This 1 million comes this one. Preference share dividend. So this after minus that dividend from the net profit after tax, then we will get the amount. That amount owner is the equity shareholder. So number of share is 2.5 million. Then earning per share is come 3,996. Huge amount. So this is the formula just for understanding. We can calculate this way earning per share. Sometimes look here what we did here, profit minus preference dividend. So this number 1 is calculating here. We divided whatever is common shareholder. So this is the item. And now, and if we go for B, assuming that the share currently trade at taka 75.80 per share, determine what the bank's dividend yield would be if paid taka 10 per share to ordinary shareholders. That means few scenario change. So that would be this one. Taka 10 divided by that means trade the market price per share multiply by 100. So do we get 13.90%. So it's come this way. This is the formula. Dividend yield equal to annual dividend 10 taka divided by current market price 75.80. So it's multiplied by 100. Then we'll get 13.90%. It's okay. Look here is the 8 marks. And another one, what would be bank's dividend payout ratio if it paid taka 10 a share as dividend? So answer would be this one. So dividend payout equal to, we can calculate this way, dividend payout equal to dividend per share DPS divided by earning per share EPS. So DPS divided by EPS, it's come dividend payout ratio. So here dividend per share 10 and also EPS we calculate in the A. So 0.03 is to 1. So this is the answer and 8 marks. Complete. Now question number 6, theory question. But you have to answer only 5 questions. 1 question is an option. So short note of hedging. What is hedging? A hedge is an investment to reduce the risks to adverse price movement in an asset. This is come from the chapter 8. So here category hedge is fair value hedge. Here risk equal to change in the fair value. Cash flow hedge Here risk equal to variability of the cash flow. Here his of an investment in foreign operation. Risk equal to here come change in V means face value or fair value or cash flow of net investment. So this is the answer. And another thing is bridge financing. Is a short note, totally 5 marks. So bridge financing is the form of temporary intermediate financing intended to cover a business short-term expenses until long-term financing is secured. So this is the what is bridge financing, saying that, and it's help to acquisition with the value add component, potential startup, etc., and quicker that means general non recourse that the interest received with the replacement should be required to non-cash flow asset. So this is the few criteria or few characteristics of bridge financing, and this is the bridge financing, and also the capital rationing. So we know the capital rationing is a strategy to pick off most profitable project to investment available fund. So capital may ration, because we know if we see the NPV, we take the decision the more in positive NPV would be the acceptable project. So how much money we have, that amount we have to invest, we have to ration in different project. So that's where come the capital rationing. And there are also your question sometimes hard capital rationing, soft capital rationing, etc. may come. And why we capital ration, or why reason for capital rationing. So there are some item also. So another thing, merger or acquisition, is just short note. So we know that what is merger and what is acquisition. It is here. And foreign exchange risks also, we know the forex risks, the financial risks that exist when a financial transaction is determined in a currency other than of the currency of the other country. So it is a few answer. And another, alternative investment market. What do you mean by alternative investment market? So answer is that alternative investor market is also the stock exchange and designed to similar companies from around the worldwide. At this moment, in Bangladesh, we have another market. We know that we have the mainframe data stock exchange, Chittagong stock exchange, I mean, that's the trade mainframe, and also now FCMA platform also increased now. So it is also the alternative investment. So this way we can resolve that type of problem. So what we have seen here, look here, yeah, it's come January 18. So total here, this is the math, this is the answer, and I think if you see positively, you will be able to answer all thing here. 100% answer can be it possible from your side.